These are 6 top stocks in pre-market with big percentage gains today. While watching bullish pre-market price actions, let us inform you our review on LSE. Leishen Energy Holding Co. Ltd. is making moves in the clean energy space, providing advanced equipment and integrated solutions tailored for the oil and gas industry. Their business spans 4 key segments, starting with clean energy equipment, where they design and manufacture essential tools like reciprocating compressor units, hydrogen compressors, and gas expansion units, key components in energy infrastructure. Then there's their engineering and technical services segment, which goes beyond just selling equipment. They customize gas injection and pressurization units, while also offering leasing, expert support, and remote diagnostics to keep energy operations running smoothly. But Leishen Energy isn't just about hardware. They're actively involved in the production and operation of liquefied natural gas, LNG, and compressed natural gas, CNG, reflecting the global push toward cleaner fuel alternatives. As demand for sustainable energy grows, this segment could become a bigger driver for the company's future. They're also embracing digital transformation, providing smart solutions to optimize industry operations and improve efficiency across the energy supply chain. With the energy sector shifting towards sustainability, Leishen Energy is well-positioned to capitalize on the transition. By combining advanced technology, engineering expertise, and digital innovation, they could play a bigger role in shaping the future of clean energy solutions. Investors watching the clean energy space may want to keep an eye on how the company expands its footprint in the coming years. Our review on BDTX. Black Diamond Therapeutics, a biotech focused on precision cancer treatments, just scored a major licensing deal with French pharma company Servier. The agreement, worth up to $780 million, includes $70 million upfront for Black Diamond's RAF targeting drug, BDTX 4933, which Servier will now develop and bring to market. This is a big win for Black Diamond, extending its financial runway into late 2026 and adding credibility to its approach. Investors should also keep an eye on upcoming Phase 2 data for its other key drug, BDTX 1535, expected later this year. Our review on ADTX. Aditxt, a biotech company focused on immune system monitoring and modulation, just had a massive surge in its stock price, jumping nearly 100% in a single session. So what's behind this big move? It all comes down to some potentially game-changing federal funding applications and a major acquisition in the works. Aditxt and its acquisition target, Therapeutics, just applied for up to $117.5 million in U.S. government funding to advance treatments for infectious diseases, including antifungal therapies and broad-spectrum antivirals. If they secure this funding, it could significantly accelerate drug development, pushing key candidates into early-stage clinical trials. This would not only enhance Aditxt's pipeline, but also strengthen its role in the medical countermeasures space, an area that has gained increased attention post-pandemic. On top of that, Apple has already secured $33.2 million in prior government funding and reaffirmed its collaboration with the U.S. Air Force Academy for its ATI 1701 biodefense vaccine. Meanwhile, Aditxt's acquisition of Apple is moving closer to completion, with a March 31st deadline on the horizon. With potential government backing and a strategic acquisition in play, Aditxt is positioning itself for major growth. Investors are keeping a close eye on these developments, as securing even a portion of that federal funding could be a significant catalyst for the company's future. Our review on XHLD. 10 Holdings, a key player in the event planning and broadcasting industry, just announced a $1 million stock repurchase program. While that might not be the largest buyback plan on the market, it's still a strong signal for management that they believe in the company's future and see value in their own stock. When a company is willing to allocate capital toward buying back shares, it often indicates confidence in financial stability and future growth. 10 Holdings specializes in virtual, hybrid, and physical event production, leveraging its Zyvid Pro platform to deliver high-quality event experiences. With the continued rise of hybrid and virtual events in today's digital landscape, demand for professional production services is likely growing. The company's ability to blend in-person and remote event solutions has positioned it well in a space that has become increasingly competitive and essential for businesses worldwide. This buyback program gives 10 Holdings the flexibility to repurchase shares over time, depending on market conditions, legal requirements, and internal business considerations. For investors, this move suggests that management sees the stock as undervalued or wants to return value to shareholders through reduced share dilution. While a $1 million repurchase alone isn't a game changer, it does reinforce confidence from leadership. If the company continues to execute on its event production capabilities and capitalize on industry trends, this could be just one of many steps toward creating long-term shareholder value. Investors should keep an eye on upcoming earnings and operational updates to see how 10 Holdings leverages this momentum. Our review on BURU. NUBURU Incorporated, known for its advanced blue laser technology, just made a significant financial move by eliminating all of its long-term debt. This gives the company more flexibility for future investments or transactions. On top of that, NUBURU secured a $5.15 million investment in Supply at Me Capital, strengthening its position in critical industries and adding a capital-light approach to its business model. These moves could help the company grow without heavy capital spending, making it a strong contender for future innovation and expansion in sectors like aerospace and e-mobility. For investors, it's a positive sign of financial health and growth potential. Our review on SIG. Signet Jewelers Limited, the big name behind brands like Kay, Zales, and Jared, reported Q4 FY25 earnings with a slight sales decline of 5.8%, but still beat estimates at $2.35 billion. Same-store sales dropped 1.1%, but they saw a 7% increase in merchandise average unit retail, UR, showing some resilience despite the drop. Now, it's not all smooth sailing. They did take a hit to operating income because of some non-cash impairment charges linked to their digital brands. But here's the kicker. The company bumped up its dividend by 10%, which is always a nice move for investors. They also bought back around $138 million in shares last year, which is another way they're keeping shareholders happy. Looking ahead, Signet's FY26 forecast is solid, with revenue expected between $6.53 billion and $6.80 billion, and adjusted EPS ranging from $7.31 to $9.10. Though the EPS range is slightly below analysts' estimates, early signs for Q1 are positive, with growth across all categories and better bridal trends. If they keep up this momentum, it could be a strong year for Signet. Please subscribe, give the video a like, and watch more from our playlist. Thanks.